We hear all the stories of these famous investors, the Peter Lynch's, the Warren Buffetts of the world, saying to be buying when everyone else is fearful and timing the market is more important than timing the market. That's great advice, but when you're in the moment and you're in the situation, it feels horrible. When you're going through a market crash, it feels horrible. This is the type of thing that I come back to. All right, this is going to be a tough update. The market, as you know, has just been crashing as of late. Individual companies have been crashing as of late. It seems like everyone that reports earnings is crashing as of late, and we just continue to get bad economic news. We got the Fed update yesterday where we're raising interest rates, and then there was some commentary from Jerome Powell that essentially tanked the market after the comments were released yesterday. This morning we got a notification that the Bank of England raises its benchmark rate by 75 basis points, its biggest hike in 33 years. And so essentially economists had anticipated the less hawkish tone from the central bank after the change in the UK government. We did see one member that voted for a 0.5% while one voted for a 0.25% increase. Okay, so some changing tone there on how much they're going to continue to raise interest rates. But here is what I think is impacting the markets today, right? So projections for growth and inflation indicate a very challenging outlook for the UK economy as it looks to bring inflation back towards its 2% target. UK GDP is projected to decline around 0.75% over the second half of 2022. Recession, reflecting the squeeze on real incomes from surging energy and tradable goods prices. And here's the thing, right? This energy crisis that's happening. Growth is projected to continue to fall through 2023 and the first half of 24 as high energy prices and tighter financial conditions weigh on spending. Inflation spiked to 10.1% in September. Mortgage rates have risen, which is making it harder on households. The government had to do an emergency bond buying intervention last month, which everybody knows about, to prevent the possible collapse of the UK's pension fund market. This is just not positive news, right? And it feels like nothing is going to change, right? And then we get earnings announcements from companies in the US, and Roku is down 21% pre-market. Over the last year, it's down from 313 to 54. And then over the last 5 years, it's now barely even up over the last 5 years, right? After this crazy run. And so essentially, third quarter results topped expectations, but they offered a weak outlook for the fourth quarter, which caused analysts to downgrade the stock. We're seeing more and more of this from companies with bad outlooks, which is essentially signaling that there's something negative on the horizon for the economy. Okay, Peloton is another one that just continues to drop and get crushed. Over the last year, it's down from 89 down to 8, which it was up even higher than that. I think it got up to like 130 or something crazy. Yeah, 156 at the beginning of 2021. And that's just, it's insanity, the amount of the drop, right? And so people are getting hurt by these stocks, the people that own them. And I don't know that Peloton so much is an indication of anything going on economically right now. It's just they're having their own internal struggles, and they have for a very long time. So I don't take anything as an economic indicator from Peloton. But the commentary was just that it's a work in progress, right? So if anybody's looking at Peloton or investing in it as a turnaround story, they still just are not making progress. Here's my portfolio, and here's my portfolio pre-market, right? And I think the entire market is down pre-market because of some of these rate increases. Datadog reported earnings. I'm going to cover Datadog earnings in the next video, so make sure you subscribe and watch that video. It'll be coming out today. But everything else is negative, right? Everything is negative pre-market. And so the question is what should we do as investors? That's the type of thing I want to provide some insight to for people out there that are just feeling so down and so negative right now. We hear all the stories of these famous investors, the Peter Lynch's, the Warren Buffetts of the world, saying to be buying when everyone else is fearful and timing the market is more important than timing the market. That's great advice, but when you're in the moment and you're in the situation, it feels horrible. When you're going through a market crash, it feels horrible. This is the type of thing that I come back to. I remember my investing time horizon. My investing time horizon is 20 plus years. But really, as long as it's 5+ years, that's how I look at the money invested in the market. I'm going to keep everything in there for at least 5 years. Nothing I need in the next 5 years is invested. This is what I come back to. All of these things, and I'm showing this chart in almost every video right now, because all of these things are reasons not to invest over the last 150 years, since from 1896 to 2016, right? But this is the Dow over that time. It went from about 40 up to 24,000, almost 30,000. And the entire time you could have looked and found reasons not to invest. Some of them, stronger reasons than others. And there have been very hard periods of time. There was a 19-year flat period in the market because of drops. There was a 25-year flat period, 16 years, 6 years. But overall, to me, these are impossible to time. Maybe somebody says they can do it. Definitely not if we have a full-time job and we're not just like staring at the stock market all day and trying to time little signals and stuff, which I don't even know that people can really do that. This, to me, is how you are successful in investing, is time in the market. And times like this right now are, if you already had a bunch invested, it's horrible. It feels horrible. It's terrible. There's nothing good to say about it. If you're in your early stages or just starting now, this is the perfect thing that could be happening to you investing wise, not economically. I'm taking all of that out. Job losses are bad. All that stuff's bad. Recessions hurt people. I got it. From an investing standpoint, if you can invest and keep your time horizon 5, 10, 15, 20 years, these are the types of situations that you wait a career for sometimes, and that you can create generational wealth if you are positioned to take advantage of them and not investing money that you need in the next less than 3 to 5 years, not on margin, not taking excessive risk with crazy options and leverage and stuff like that. If you have a smart investing strategy, a long-term dollar cost averaging type investing strategy, these are the times that you can really create generational wealth opportunities for your family, yourself, 10, 15, 20, 30 years from now.